Okay, so the train is running late. Let's try and run faster, right? I thought we'll end with rapid fire, but I think we need to start and finish with rapid fire. Is that it, Siddharth? Ladies and gentlemen, I'm Jaideep Dang. I work for JLL, and we facilitate hotel capital markets transactions. We provide advisory whenever you're building a hotel, right from buying a hole in the ground to buying cutlery, we do everything. But what we don't do is what all of these people do, which is putting in the capital in those projects. So I'm very happy to have Mr. J.B. Singh, Raghu, Mr. Dangayach, and Gyana. I have the privilege of working with each of them, and in many ways and many confidential things, but this is that forum where we're all together. I make sure that we stick to the syllabus and stick to the time. So, JB, if I may start with you. You see, why this is important is because a lot has been talked about generating employment. Honorable Minister mentioned in the morning about the potential that the culture and the tourism has for this country. Whatever we've built so far is great, but then the big question is, are we addressing the big demand which is coming our way through domestic travel, a lot of premiumization in hospitality from mid-scale to upscale, from upscale to luxury. So who's really putting money behind it so that we have more jobs, we have more revenues to spend money and to gain those experiences that everyone look forward to? JB, you've done it before. You started the story with InterGlobe putting in capital along with your JV partners in one platform and in another platform with another JV partner. And you have done that story with the brands putting in money in that as well. So how many hotels now, JB, with InterGlobe, and how many more to come?
Yeah, so just to sort of set perspective, we opened our first hotel in 2008 in Gurgaon, which was just over 200 rooms. And in the next 14 years, we opened 28, now almost getting to about 6,000 rooms. So it's been very, very rapid growth. I think we at InterGlobe firmly believe to build long, sustainable businesses. We take a very long-term view. And we approach it in a very, very sort of a structured way. And that's been our journey. Most of our strategy has been around densification, so we are centered around 13 cities, largely in the IBIS sort of format, the sort of the mid-market, etc. Of course, we have some Novotels and the Pullman through one of our other JVs. So we'll continue to do that, Jaideep. This fast-paced growth, and we continue to build through COVID, which was very interesting, very exciting. Post-COVID, we opened 5 hotels. We have a new one coming up in Mumbai, in BKC, 207 rooms, which will open in 2 months' time. We've got another one under development in Bangalore, so that's going to continue and should open in about 15 months. And we are now evaluating markets like Delhi and a couple of tier 1, 2. But just to give you a broad flavor on how we look at growth, for us it's been densification, go to a market, just keep building in those markets. We do believe there is a huge urbanization trend going on in the country across 6, 7 big urban cities. Delhi, of course, will become the most populous by 2030, and so on and so forth. So we'll continue to follow that, stick to densification, and go into markets which have clear and present demand.
Great. Just to put some data and put things in perspective, last year we saw about $350 million worth of investments in capital coming into operating assets, which is roughly 2,800 crores. This year, that number that we see and we forecast, and a lot of it is being done, is about 3,500 crores. So never before we saw so much of money coming into hotel asset class, right, as it has over the last couple of years. And a big participant in that is is SAMHI Hotels. Gyana, I bring this to you. He loves data, SAMHI loves data, that's why I tried to put some data. And giving you a segue into it. Yes, you're seeing that as well, great. So what is next level of growth? And congratulations on doing what you've achieved. A very successful IPO last year. And what is in it now in store for SAMHI Hotels?
Thank you, Jaideep. Pleasure being here. I think what SAMHI's growth, we've been now in business for about 13 plus years. What is our core strategy has been business in key markets. What we continue as key markets means we continue to invest in places where there is data available. And it may sound very boring, but wherever there is information available regarding the demand and the existing supply is the markets that we go into it. Not that we don't believe in the tier 2, tier 3 market or a leisure or luxury side of it, but wherever there is credible, reliable information available, we will go into that market. And Mr. JP, whatever he said is Mr. Singh also, it's very similar. We like to densify the market. That means in tier 1 markets, we will like to have multiple assets. We are a brand independent company, so we are not associated with any exclusivity with any brand. We have multiple assets with single brand, but we will like to densify wherever those markets which have good visible business demands existing and supply is there, and there is proof of concept. What do you mean by proof of concept? Means there are existing branded assets which are performing consistently and we can benchmark with them is the markets that we would like to go in. So that means top 6, 7 tier 1 markets.
Great. We've got a very interesting mix, if you've noticed on the panel. So from a listed company, I moved to a REIT. Raghu, again.
Which is listed as well.
I beg your pardon?
Which is listed.
Which is also listed. But again, very unique in many ways and a kind of a frontier institution. For the first time you see in this country a REIT holding hotel assets, marquee hotel assets sitting in the office portfolio. What does it really, what do these assets bring to, let's say, the overall mix? And I know you're concentrated in one city, which woke up late after COVID. We were talking about it, but it has waken up, and how? So what does it really mean, and what's the road ahead?
Thank you for having me on the panel, Bhuvnesh. So firstly, I'll just give a context on REIT because many people don't know what a REIT is all about, right? So REIT is essentially a real estate investment trust in which we are focused on commercial real estate in India at this given point. And it is over-regulated and very high corporate governance. And we essentially distribute 90% of our cash flow. And at any given point, we have 80% of our assets rent generating. Now, REITs are very well known in the US, which is the capital of REITs, and of course, when you come to Japan and Singapore as well. But when you come to India, there are just only 3 REITs. Of course, we were the first one to list in 2019. It's a very new product in the market. But it is essentially focused on commercial, and there's one REIT which is retail, which is the Nexus REIT. I think so everyone's aware of that as well. Coming to our REITs, our hotels are part of an amenity to our tech parks. We own close to around 50 million square feet of office space. Us doing hotels in the tech park is to ensure that it adds as a value add-on. It's an amenity. It ensures that the total ecosystem of our tech parks is evolving. It is giving the need of conferencing hotel stays to our tenants who are staying there, and of course adds value overall from rental perspective as well. On an individual performance basis, in due course of time, we've seen that the EBITDA per square foot, because I'm always judged on that compared to commercial, it eventually catches up to commercial. It's just the gestation period which is different in the both asset classes at this point. But having said that, hotel REITs, you've got a lot of hotel REITs in the US as well, right? Like, case in point is Host Hotels. Would hotel REITs come to India? This is a question which I am asked a lot. I would say the answer is yes, but it will take some time because currently the commercial REITs itself have to mature in India because It's an asset class which lets every individual who wants to own commercial real estate and get rent generation out of it, because we distribute the rent, to mature. So once that maturing of the commercial happens, then if the hotel business also is more predictable and stable, we should be able to have hotel REITs as well.
Great. I move this to Mr. Dangayach, who brings a very good mix to the panel, because we've seen institutional money, we've seen in various forms, and here is, let's say it started as a family office business, right? It started from that aspiration of building the first best hotel in Jaipur, and you succeeded, and then came more. So what was, let's say, the motivation to diversify? How did this first occur, and what's the road ahead?
Thank you everyone for having me on the panel here. I believe we are passionate hoteliers, right? You have to be passionate about any business that you own and you run. And I clearly remember opening the first Park Plaza in Jaipur with the best bar in the city. At that point in Jaipur, drinking in open, everybody said, who's going to come and drink in an open bar? And we go, no, we're going to change the city landscape, and which we did. People were saving money to go to the Jeffrey's bar just to have a drink on the weekends, what I've heard. Starting from there, moving into future, we feel hotels is a passionate project. Not only we create hotels with passion, we tie up with global brands who fit that piece of real estate we are creating, right? And in the cities that we go to. So we are known, Dangayach Group is known clearly for developing and owning numerous assets in multiple cities, which gives us good exposure to varied market segments, from business travel to leisure, to weddings, events. And yeah, it's a great time to be in India. We're very fortunate that we are at the forefront of this growth in Indian economy. And very exciting time to be an Indian hotelier at this point, we feel.
Great. On that note, what do you prefer? And this could be an objective answer, and then I can always ask you for the reason behind it. What do you prefer? You've already done greenfield development, buy land, build hotels. Are you also looking at buying something which is operating, which is also the trend that we are seeing, or will you continue the greenfield story?
So greenfield for us is only because of the quality that we can offer to the customers and the brand promise that we can bring with the new construction. We are going to look at operating hotel assets as long as it meets our criteria. First of them being strong box, good bones, something we can put a flag on and deliver quality to our customers, right? I feel a lot of old hotels in India were not quality conscious. New construction has really improved. And yeah, as opportunities arise, we may look at that, yeah.
Gyana, you've recently showcased an example of a blend. You bought something and then you will perhaps build more. So what's the pattern that you're following, or what does the direction that you have?
No, I think, Jaideep, we will maintain that storybook that we have in the last decade and a half onto it, is buy and renovate, add value onto it. I think that's a story that we can do because we understand that we are capital managers. We are not, we are a bunch of professionals who come founded by Ashish itself. So we are purely institutional capital managers. And institutional capitals are not that very patient. The patience is more than year and a half, 2 years. So we can't, in Greenfield, it's fantastic. I think one of our most successful hotel in our portfolio is actually a Greenfield, which is a Courtyard Fairfield in Outer Ring Road. But having said that, that's not what you can build a portfolio of it. Out of the 32 today operating hotels, 28 are bought in various stages of whether it's operating, brownfield, in different stages. Only 4 were constructed. We will maintain that story. I don't think so. We will deviate from that. We are okay to do build to suit somebody else, and then we put the capital later on. But our focus is to capital to revenue cycle as shorter as possible. That's been our focus, and we will maintain that focus.
Sure. And GB, yours is a bit of a contrast, right? You've preferred building hotels, buying lands, and what you've done brilliantly well is the speed to develop, right? Where others suffer, you've kind of just got the prototype right, and you're in a factory settings mode. Will you continue doing that, or looking at operating assets as well?
Yeah. So all of them are now greenfields. And it's not that we are averse to brownfields. We have evaluated many, but a lot of the reasons have been set on the table around quality and things like that. But most importantly, for us, it was also right sizing of assets. So we are very, very focused on GFAs and bringing in operating efficiencies once the building gets built. So we've looked at, I mean, I think if I'm correct, we've walked over 400 sort of brownfield opportunities, and they failed on some test or the other, whether it was the right sizing, they were overbuilt, or quality, price mismatch, even if you got close to something. I remember we got very close to one lot at one time. But compliance. We are again very hung up on compliance and making sure our buildings are 100% compliant, both from a stat perspective, operating perspective, and so on. So to answer your question, I think it's going to be greenfields, unless an absolutely sterling what comes that completely fits into our sort of framework, it will continue to be greenfields.
Maybe at some point we should exchange notes. You've got 400 hotels that you've seen and not bought. Perhaps just exchange that list with us and we'll find some solution for them, if not through you, right? Nevertheless, Raghu, I take it this question to you, but with a different spin. You've got again, a very diversified portfolio. You've got a Four Seasons, you've got a Hilton, you've also got a Garden Inn. In terms of your asset management experience, what has really delivered the best yield so far? And I'm saying segment, I mean taking the brands out.
Catering and MICE and rate, right? I think so there's two things which eventually drive yield is rate. So as a company, we're a very rate focused company because please understand we're into distribution of cash flow. We're not as REITs. So from a yield perspective, of course, our hotels combos at Manyata, I think so have delivered exceptional yield, and we've actually run yields after opening and after 2 years of stabilization as well. The numbers are pretty strong there.
Talking about yields, Gyana, is there a sort of a hurdle rate that you look at when you assess?
Yes. I will answer that. I think, Jaideep, I would add to the question that you had asked previously is that I think a lot of times we have been asked, because we operate from a mid-scale, upper mid-scale to an upscale segment. I think a lot of time investors do ask us, and our shareholders and market do ask us which segment kind of performs well. We have maintained that answer is that it's not the segment, it's the market which performs. Okay. If you put any segment of hotel in a performing market, all of them perform well. What happens is that it just happens to be that the upper mid-scale or upscale segment and luxury segments, all of them are located in tier 1 market. So the reports come out that they are outperforming. But what we have seen is that whether it is a mid-scale hotel or an upscale hotel or any other hotel, so long as it's located in a great market, it outperforms. So it's depending on the market to market, not the segment to segment. If the market has a good demand, it performs well. So I think we would like to break that myth that it's segment which performs. No, it's not the brand, it's not the segment, it's actually the market. So we can give an example is an outer ring road market and a Fairfield, which is a 19 square meter room, sells for a 10,000 rupee rate, outperforms some of the upscale and luxury markets in same Bangalore city also. It's just the outer ring road market which is an outperforming. You put any other hotel, it will outperform. Second point is that what you asked is that what is a threshold? Yes, as an institutional investor, we maintain that we would look at a ROCE, and it's more accounting ROCE, and both accounting ROCE and NOI yield. NOI yield will be an EBITDA over the invested capital. Both have lag slightly. ROCE will slightly lag behind NOI yield, and NOI will lag behind after 3-4 years because of the depreciation onto it. So from a ROCE and NOI yield, we would look at a mid-teens to high-teens threshold. I'm not saying that that's the target that we do it, but we would like to see an existing return capacity of one portfolio between mid-teens to high-teens. That's kind of a range, but it depends on opportunity to opportunity. It seems that sometimes it's the how much multiplier you can do for the bottom line. If you're acquiring an asset at X crores of bottom line, can you do a 4X, 5X is also a question that we also see to it. So different matrices onto it.
Sure. Mr. Dangayach, builders of real estate across property segments we've witnessed in this country last 10 years have stuck to a a core market, whether it is Prestige playing in its own market, Embassy playing in its own market, DLF here playing in its own market, then you have the Bombay big guys playing in their own market. But recently we see a trend that everyone's diversifying. They're getting into each other's territories. And I'm saying different asset classes. You've also stuck to your core so far, Rajasthan and the story around it. Is there any other thought which comes to your mind? Hey, listen, let me go to other markets. Let's build the story again somewhere else. Is that on your cards?
Not really. We're not market specific. We started with Rajasthan, so we wanted to become a strong local player, strong regional player. Now the inspiration is to become a strong national player and look at the key markets in India and focus on our strengths, right, which is really building quality hotels at great value, great cost bases, and good brand partnerships, which we're blessed to have with most of the brands, major brands here. So the goal is to, continue to grow, continue to identify growing markets, identify the segments which are missing in that market, and build fast, deliver quick, get returns. That's our motto.
Great. I guess the train is reaching the terminal station, and let's change the trend and be on time and make all the others sweat it out, right, after us. So shall we go to the last conclusive thought? A lot of people ask us all the time, what do you think? What's the visibility like for next year? Is the trend on room rate growth and occupancy growth continue forever? Or is it plateauing? Is seasonality coming back? JB, you handle a large portfolio, especially in a rate-sensitive product. What do you see happening in the next, I would say, 1 to 3 years?
So the growth will continue. Of course, we've seen a meteoric rise because the base was so low coming out of COVID. So that's going to sort of start to, I won't say flatten out, but will continue to grow. GDP should continue to grow, as we all know, and to a GDP factor, hospitality will continue to grow. There are supply issues in key markets. That itself will also push demand up. Many other sort of pricing up, and many other demand drivers are coming in, from the MICE perspective, Yashabhumi, Geo, sporting events are coming, are becoming more sort of, domestic travel is growing, and as Patu eloquently spoke about, spending capabilities and etc. So there are enough demand drivers coming out of the market. So we are very confident it's going to continue to keep growing. And again, to your point, we have to be very sensitive to the markets that we go to and make sure that we are present where all the other criteria are there to keep driving solid growth. I mean, AeroCity's seen very different kind of growth than other markets have.
Raghu?
Okay, I'm a commercial REIT, so I'll again talk commercial real estate. Just give you one data point because there's some data which was discussed this morning. India office space is 800 million square feet. US is 4.8 billion square feet, right? So that's the mountain for us to climb. Of course, we might not reach US numbers. Again, another analogy we may look at whichever way, our office space is 17% of what US total office space is. If you look at our branded rooms, they are probably in the range of 3 to 5% of US. So just that mismatch is so humongous that over the next 3, 5, 10, 15 years, this demand is going to continue. So I would say RevPAR growth will continue. Of course, ADR growths might taper off a bit, but of course, they will continue to grow, but not to the same double digits how they were growing. But again, could be different for certain markets and segments.
Atul, maybe you go ahead first.
I think growth is definitely going to come. We have the youngest population globally, 28 average age. They're going to grow. They want to travel. They want to experience their own country. My problem is the barrier to entry in India, the land acquisition rules, the conversion rules, the licenses. I wish they would make it easier, simpler for us to buy the land, get it converted, move fast, build a property. I think that's where the hurdle is, not the growth. It's how fast we can bring the inventory on the market. That's where the hurdle is.
Same thought. I think India's growth is inevitable. Growth is like age in India. It has to grow. So I don't think so there is any challenge in that. People making statements that today we did highest ever. Of course, I'm the oldest ever. So in India, I think for our belief is that looking simple fundamental data, 2-3 decades, I think we don't have to worry about unless something very large which we don't know about yet today. Otherwise, we are bullish about growth. At different scale, people have different notion about what is the quantum of growth, but that I don't want to debate. Everybody will have a different philosophy about it, but growth is definitely there.
Sure. I genuinely feel that given the traffic and the time that we spend on roads, despite of all the infrastructure growth that we have, yes, we have a lot of people, but then a lot of cars. We take a lot of time from point A to point B. We need to stop by and not go back to our own town. So we need to stay a night, whether we are going for work, extend our stay when we are going for holiday, because the traffic and the way we are will not allow us to exit too quickly, right? So that means we need more rooms, we need more supply, we need more heads on the beds, right? And ladies and gentlemen, we have the sharpest set of investors talking all the same script in their own different ways. So that means good news for all of you. We'll have more jobs, we'll have more revenues, we'll have more experiences that we can take back home, because these guys are putting more and more money for all of us. Thank you very much, ladies and gentlemen. Thank you.
Thank you.